Jamie Reid here with C3 Academy. We're going to talk about the ever exciting and sometimes confusing clause found on property insurance policies called coinsurance.
Insurance companies use coinsurance provisions as a way to assure that you are insuring your building to the proper value. Now, it's important to know that at the time of loss, typically it's only a fraction of the building that's lost and not the entire building itself. So insurance companies will take a look at the value you insured that building for at the time of loss, and if necessary, apply a coinsurance penalty against that smaller claim. So let's take a look at the formula and see how it works. All right, for this first example, we're going to make it really easy. We're going to say that we did insure our building at a value of $500,000. When in actuality, we should have insured the building at $1 million. We're going to use a coinsurance requirement of 100% because that makes math the easiest, and it'll shorten our three-step process to really a two-step process. And we were going to say that we had a $100,000 claim. So $500,000 value that we did insure the building for, a $1 million value that we should have insured the building for, and a $100,000 loss. So using a 100% coinsurance clause, let's take a look at the math. The first step's real easy. We take the value that we did insure our building for and we divide it by the value that we should have insured our building for. So for this example, $500,000 divided by $1 million gives us a factor of 0.5 or 50%. In step 2, we modify that 0.5 by the coinsurance amount. Since the coinsurance amount is 100% for this example, the 0.5 remains 0.5. The third and final step is to multiply our factor by the claim value. So our factor for this example is still 0.5 times the $100,000 claim that we had. So ultimately, only $50,000 of your claim will be insured, and another $50,000 will be uninsured as a result of the coinsurance penalty. Now let's take a look at the same scenario, except with an 80% coinsurance requirement, which is less restrictive or more forgiving at the time of a loss. Step 1 will remain the same. We take $500,000 and divide it by $1 million to give us a factor of 0.5. Step 2, however, we will take that 0.5 and divide it by 80% to modify that factor to 0.625. In our final step, we will take that 0.625 and multiply it by our claim of $100,000. That would give us a final insured value of $62,500, or an uninsured value, a penalty, of $37,500. You might ask yourself, how do I avoid a coinsurance penalty? There's a couple options, but the best option is to make sure the building is insured at the proper value. As you can see from this example, had we insured the building at an $800,000 value, even with a coinsurance penalty of 80%, we would have satisfied the requirement of the policy, so the $100,000 claim would have been fully insured. The other way to avoid a coinsurance penalty is to have an underwriter waive the requirement of having it on a property policy. Often an underwriter will do this if they feel comfortable that the building is insured at the proper value. So ultimately, the two options are fairly similar, and having your building insured at the proper value is the best way to avoid having this type of penalty applied in any sort of claim scenario. And that wraps up the exciting world of property coinsurance. If you have additional questions, please reach out to us, relations@c3insurance.com. Thanks so much and have a great day. If you enjoyed this educational video, please click that like button down at the bottom left-hand corner and then move on over and punch that subscribe button for us. Thanks so much, and we'll see you in the next video. Be on the lookout for more C3 Academy videos where we take complex insurance topics and we break them down into terms that normal business people can understand.